Weighing on the market, the Wall Street Journal reported over the weekend that the Federal Reserve may be getting ready to scale back its bond buying program. Currently, the Fed buys $85 billion a month of mortgage-backed securities and treasuries. And when the tapering action may start is still being debated. The Fed's quantitative easing, or QE, program has fueled a rally in the equity markets, and stopping the stimulus is generally viewed as negative. The stimulus measures have been in place since 2008. And joining us with more on this is Sandy Villere. He's partner and co-manager at the Villere Balanced Fund. Sandy, thanks for joining us again.
Thanks for having me.
So, Sandy, do you think that the Wall Street Journal article is accurate in predicting or forecasting that the Fed is starting to think about winding down QE3?
Sure, they're starting to think about it for sure, but I don't think that until probably Janet Yellen replaces Bernanke in January, I don't think we're going to see that happen over the very short run. But eventually, rates have to go up, and the Fed's well aware of this.
Well, the Fed initially said that they were going to wait for an unemployment number to hit 6.5% before they start to take any action. We did get some positive news on the employment front. Jobless claims hit a 5.5-year low. Unemployment is now at 7.5%. Is this going to trigger some kind of winding down of a reduction in the nature of the purchases? Or again, you don't expect anything until January of next year?
I think it's going to take some time. I mean, at some point this will happen, but it's not going to happen over the short run. And I think it's funny when you look at unemployment, it's a very lagging indicator, right? So anytime you go back to 1948, anytime unemployment's been over 6%, the market's actually done about 13.2%. And anytime it's been under 4%, the market's actually delivered about 2%. So it's a very lagging indicator. So it's something that I want to look forward, to.
So do you think that the markets would be able to handle the withdrawal of the artificial stimulus?
It's going to be very interesting. They got to be very careful. They got to balance, whether or not we're going to have inflation with what's going to happen if they unwind. So they've got to be quite careful the way they handle this, and I think they will be. They've just got to do it just perfectly.
So the Fed is just kind of conditioning the markets to this idea, putting this notion out there, so there's no major shock value when it happens.
They want to give as many hints and as many signals as they can that this is going to be coming. And I think everybody knows when you go back to September of 1981, rates were at 15.84%. Here they are at a 190 on the 10-year. So at some point, rates, I can't tell you when they're gonna move up, but at some point they will.
Do you expect to see rates being increased whilst bond purchases decreased simultaneously, or one sort of first and then the other?
I think we'll probably see the Fed stop this bond buying program. When the QE ends, I think you'll start to see rates move up. And at that point, they can see where they are.
Now, because the market has been fueled by so much artificial stimulus, especially the housing market, what will it mean for the housing market if the Fed starts to pull back?
Yeah, I think they've got to get the housing market under control, which they have. And at this point, you've got decent unemployment. You've got a housing market that's very stable. So at some point, they've got to let off the gas to control inflation. And so I think they will do it. And it should ultimately be just fine for housing. I think it's not gonna really hurt it too badly. It's gonna maintain itself.
Now, U.S. markets have been on an absolute tear year to date, up between 14 to 15%, the three major averages. Do you think we can continue with this momentum? If this is just talk in the interim, do you think this momentum still has room?
I think it does. First of all, what are your alternatives? You could buy bonds that are paying, like I said, 1.9%, or you could buy good quality growth stocks that are even some that yield a decent amount. And I think that's what's going to happen, is that people are going to continue to buy stocks. And I think we're looking at a market that's going to continue upwards by the end of the year, and it's still cheap relative to historical. You look at the forward price to earnings multiple on the S&P is about 16.6 times, and right now we're at 14.5 times, so still cheap, actually.
I want to focus very quickly on that retail sales number. Consumers undeterred, they still spending. Is this spending coming from income, or are we going back to our ways of borrowing and spending on credit?
Actually, the consumer is doing pretty well. At this point, the consumer has a higher net worth than they've had really in history, and everything's looking pretty good for the consumer. So I still want to see what happens with, right now we've got the consumer that's been, it's about 70% of GDP, right, that's consumer spending, and about half of that is coming from the number we just saw today. So we need to see what happens in 2 weeks when you look at the personal consumption and how that shakes out. So we'll see where we go from here.
We will indeed. Thank you so much, Sandy Villere.
Thanks for having me, Michelle.
We're going to have to leave it there. That's Sandy Villere, partner and co-manager at Villere Balanced Fund.